Welcome everyone to the Marsh webinar New Risk Order. We will be starting our webinar very shortly. Welcome to the Marsh webinar New Risk Order Evolving D&O Risks and Insurance Solutions. We have a number of participants who have already logged in, and I can see many more joining by seconds. We'll wait for a minute or two maximum, and then we'll kickstart our webinar. Once again, a very warm welcome to all the participants who have joined in for the Marsh webinar, the New Risk Order, Evolving D&O Risks and Insurance Solutions. I am Sanjay Kedia, CEO for Marsh India. I will be shortly introducing the panel, but before that, some housekeeping. All the participants have an option to raise a question or share a comment by pressing the Q&A tab, which you can see on your screen on the bottom. You can raise your question at any time during the entire program. If you raise your hand, we will try and unmute your line during the question answer session and get you an opportunity to speak your question to all of us together. We'll also be having some live polls. We encourage your participation in the same. Next. Today's series, the New Risk Order Directors and Officers Risk Insurance Program, is a part of a larger series which Marsh is running in India by bringing the very best experts on the most important risks of our time. We have the next program coming up on November 2nd on cyber resilience. Again, we'll be getting the global expert for cyber resilience from the US and Asia to speak on the same. We will be having on November 3rd, a seminar on parametric solutions, which is gaining a lot of interest. And on November 6th, on risk finance optimization. The entire COVID situation has brought geography agility, our ability to come together and bring the global experts and local experts coming together to discuss a subject of interest and have an open session has never been more interesting. Today's panel members today, let's have a look at them. Next. I'm pleased to introduce Shaunna, the leader for Marsh globally on management liability. So thanks, Shaunna, for joining us today. She manages some of the largest programs in the world, and she has been very helpful and instrumental in supporting some of the many large Indian companies programs which are listed in the US. So thanks, Shaunna, for all your support. We have our Asia leader for this business, Sharon Kerr, and the partnership of Asian markets, the Asian expertise, combined with the global leadership of the UK market has been never more useful as times are changing. And all of you know Anup Dhingra very well, Managing Director and FINPRO Practice Leader for Marsh India, and Nachiket Shah, who specifically leads the management liability business. So we have the best of the speakers around this whole subject. So let's start with a quick icebreaker on the poll question. How are you feeling today? Good to see such an overwhelming response of people fine, over 90% calm. Yes, next. Is directors and officers insurance a boardroom agenda in your firm? Yeah, around 2/3 believes it is a board agenda. Now, before I hand over to Sharon for the next slide, a quick comment. As we have been organizing these webinars on different risk issues, it's very important to look at the larger framework on these risks. MMC released a global report on COVID recently for World Economic Forum. And it had some very interesting broad frameworks. We saw a risk which emanated from a health crisis turned into a financial crisis is a bigger risk. And we all know a larger financial crisis leads into other interconnected risks, including governance risk. And what we are discussing today is that when many different forms of risks in these times of uncertainty are activated, are more volatile, are more uncertain, the D&O risks, the directors and officers risks get further accentuated. Indian market, we have seen so much changes happening on the various corporate laws, Companies Act, bankruptcy code coming in, insolvency professional code coming in. We all know in the last decade or so, many of the companies' law have been turned a civil situation into a criminal liability also for the directors and officers, though some of them have been relaxed in the latest change done in the last few months. But the challenge for the directors, the accountability for the directors is increasing tremendously, even in the Indian context. The company's law does provide a possibility of a class action, even in the Indian context now. So with all this action going in and with amount of uncertainty certain industries are facing more than the others, We could not have asked for a better panel. And with this, I would hand over the speakers to Sharon to take this forward. And today's proceedings will be moderated by Anup. And we really encourage all of you to keep raising questions and comments as you feel. So with this, Sharon, over to you.
Great, thank you for the introduction, Sanjay. And I just wanted to also thank you and Anup and the team for including Shaunna and I in this presentation series. We're a pleasure to be here today, so thank you. Look, let's get into the detail of this. We wanted to start, I guess, over the next couple of slides by looking at really how the D&O liability market has evolved over the past decade or so, and touching on where we've been, where we're currently, and what we can possibly expect in the future. Okay, so to start with the evolution of the D&O market, I think we really need to look back 20 years towards the turn of the millennium for the last really challenging market in the D&O space. But certainly since 2004, the D&O liability market has very much been a buyer's market, which has been fantastic for our clients. And during this time, it's meant we've been able to significantly enhance coverage. As the products matured, our client base has expanded, more and more people are buying D&O. But at the same time, what we've witnessed is the product has become increasingly commoditized. So what this has actually meant is that in most countries, for most clients, generally speaking, you could purchase an off-the-shelf product from a reputable insurer on either their own wordings or a broker wording on very broad terms and at really, competitive premium levels. For our larger, more complex clients, of course, we're able to push the boundaries of coverage even further with bespoke solutions and really complex program structures. So this, generally speaking, has led to what we've seen is that clients have been buying higher limits, expanding their coverage to include, an increasing variety of risks that are not considered core aspects to D&O. And we'll talk about some of those a little bit later on. But I think it's also important to note that during this time, there was an abundance of capacity. I recall during my time in London a few years ago, placing limits of £500 million for our largest clients with no issues at all. And that was when the pound was more valuable than it is today, which has obviously significantly decreased in recent years. But also, in addition to this, I think what's an interesting fact to note is that, yes, there were particular clients that had particular claims, but I think it was really debatable as to whether we saw any actual claims trends, which we're definitely seeing now. And again, as we go through this presentation, we'll touch on what some of those claims trends are. So look, as I said, it's been good for a long time, but we are where we are now. And that's that in 2018, we really started to see things change. Slowly but surely, in most parts of the world, the market cycle turned. So what we're faced with now is a market where, generally speaking, claims are increasing in frequency and severity, capacity is reducing, underwriting scrutiny increases, and coverages are being, reviewed very carefully. And unfortunately, we're seeing premiums increase. So I think just onto the next slide, if that's okay. Great, thank you. So look, I think, the point of this slide really is to demonstrate that the insurance market, like any other market, operates in cycles. And those cycles occur over a period of time. And as we've discussed, if we look at this cycle, we've very much been in the top right-hand corner of the cycle, represented by the blue diagram there, where, as I mentioned, capacity has been abundant, competition has been fierce, and rates have been steadily decreasing year on year. Now, our view is that most parts of Asia started to move through the bottom green section of the cycle towards the end of last year. And this is really when most insurers, they started to look at their own financial performance at a global level, which, quite frankly, was being impacted by poor investment returns and the occurrence of losses. Now, on this point, I think it's worth mentioning that in the financial line space, certainly across Asia, and I'm sure Anup and the team will also say the same of India, the claims experience is generally still pretty good, still pretty favorable. But we're at the point, unfortunately, where most insurers regionally although they may be running profitable portfolios in the region, in Asia or in the country, they're faced with the challenges at global level that they all have, which means that rates and coverage offered in Asia that we have seen for some time are no longer sustainable. So this year, accelerated in part by COVID and the wider economic environment that Sanjay touched on earlier, we've seen, insurers' results deteriorate even further, and capacity has been increasingly being withdrawn from the market. To be honest, and quite rapidly in some cases, it's changing week by week. So again, on the point of capacity, I thought it was worth mentioning that capacity and the lack of capacity has not only been caused by several key insurers actually withdrawing from the market completely, but also those big, large multinational carriers that we traditionally rely on in this space, the likes of the AIGs, the Chubbs, the Alliances. They're actually reducing their capacity in some cases quite significantly, where in the past, we may have seen them put out $30 million or $40 million or even $50 million. These carriers are being much more cautious now about how much capacity they're willing to expose to any one client. So all of this, has really reached the point, and I apologize, I've just noticed an error in the slides, let's say October 2020, but it's reached the point where we are now, quite frankly, which is the orange section, which is where we're seeing insurers restrict their appetite in regards to certain industries and sectors. And in some cases, rates rise quite strongly. So look, we'll go on to, again, more specifically, industries and clients that have been most impacted. But for now, I hope that's a good overview of the cycle, and I'll just hand over to Shaunna to talk us through some of the data around premium trends.
Thanks, Sharon. Yeah, so we thought it might be interesting to show you sort of what this market evolution looks like in terms of the premium trends. So we've got two graphs here. The top graph, if you look at it in isolation, it looks like 2019 was a real knee-jerk reaction, a sort of really extreme movement in pricing. But, I think on its own, it does look like that, and it is sort of quite a sharp change from the last few years prior to that. Sorry, by the way, about the if you can hear the background noise. But then, you look at the bottom graph, and I think that gives it the context that you need to see that really this has been a sort of a market cycle in the making for the past 18, plus years since the last hard market in 2002. So, we saw a continual decrease in pricing, and this was driven by, really an oversupply of capacity. The sort of many insurers were in aggressive growth modes. It was a case of wanting to win market share at, any price. So it was competing on costs, but also on deductibles and coverage to win that market share. And that drove the premiums down and down over a number of years. And so actually, when you look at the bottom graph and you look at the premium trends over a longer period of time, you can see that actually that 2019 spike only sort of makes a slight dent in those continual decreases that we saw in the years prior. And just to comment that this data is specifically from UK placements, which incorporates a global portfolio, but those trends are pretty similar sort of on a worldwide basis. Before we go into more detail on those pricing trends and kind of the different markets around the world, we just wanted to ask you another poll question about your own experiences. So asking you, what premium increase did you experience in your last D&O renewal, if you can remember? I mean, they're quite broad categories, so make a vote and then I'm interested to see the results. Okay, are we? Yeah, there we go. Okay, so it's quite a spread there. I think it's probably, and we'll sort of get into this in more detail, it's quite reflective that, some of you still saw small increases or no increase at all, and then on a sliding scale up from there, really some very large increases, and you know, we'll probably get into the details of who that possibly applies to, and then you know, a third of you seeing a moderate increase. That's interesting. So if we go on to the next slide, then you can see these sort of two graphs split in two halves. So you've got on the left-hand side, we've got global pricing trends. So sorry, the writing's quite small, but you've got property, casualty, and FINPRO pricing. As you can see, FINPRO is sort of leading the charge in terms of the size of the increases. The FINPRO pricing includes D&O, management liability, but also PI and cyber pricing is in there as well. And then you can see on the right-hand side, this is specific to the UK market, which is where I operate. And you can see the bottom graph there, that's FINPRO increases or pricing trends. You can see it's really quite a drastic movement, particularly in the last 3 quarters. You know, the average increases being over 50% in the last quarter or quarter 2 this year. So I think the UK market in this particular hard market is probably one of the first markets to change and to harden, and it's probably 12 to 18 months ahead of where the Asian market is in terms of pricing. Charlie leads on to the next slide with Sharon.
Yeah, thanks, Shaunna. So the good news is we're not quite there, as Shaunna mentioned, in terms of Asian FINPRO pricing. So in Q2, we witnessed overall an increase of average on 14%. Now, as Shaunna mentioned, this covers a variety of products, not just D&O, but of course in Asia, it covers a variety of countries and territories. And just interestingly, I've seen the Q3 data, which is about to be released, I think, any day now. And that trend increases. So in Q3, what we're seeing for Asia FINPRO is that rates are going up by 17%. But it is interesting if we look at the differences between the countries in Asia. I'm pleased to say India was actually not quite that high in terms of the increases that we're seeing. Interesting to get the team's views on that a bit later on. But certainly in the markets that we use typically to access the multinational carriers like Singapore and Hong Kong particularly, I would say that their increases are probably, you know, around 20 to 30%, so a little bit higher. And then we have markets like Japan and Korea who very much rely on their own local market, who actually in some cases are managing to you know, keep some of those renewals at flat. So it's a mixed bag for Asia, but certainly we're seeing the upward trend continue. So just moving on then to the next slide. So, you know, we've talked about the data, you know, but what specifically, particularly for Asian clients, has changed? You know, really, you know, from an Asian perspective, and I don't think India is any different, Asian risks have traditionally been regarded as low risk in this space due to the litigation environment. You know, we don't see or haven't traditionally seen many D&O claims, but there are several key trends that have emerged, particularly in the last 18 months, that have really had an impact on how the insurance market views Asian risks. So the first of these, and I think, you know, potentially the most significant actually, is the rise of the Asian multinational. Now, of course, you know, Asian multinationals aren't new, but, you know, what we're seeing is as Asian and Indian companies continue to expand their operations overseas or seek to raise capital in foreign markets, their D&O exposures increase, you know, in some places quite significantly. So in addition to that, you know, exposure to international securities in foreign jurisdictions, they're also, of course, exposed now to an increasingly complex web of international regulation, such as sanctions, bribery and corruption acts, and also in-country regulations regarding specific issues such as data protection, you know, and employment-related law. So, you know, even though primarily in Asia, we're still seeing the claims environment is quite favorable, we're increasingly seeing Asian clients experience claims from overseas, from their operations overseas, that has really led to our insurance market looking more closely at the risks associated with our clients. So just to move on to the next section of this, which is, sorry, staying on this slide, sorry. I think we're getting a bit ahead of ourselves. So thank you. Okay, great. So just moving on to the next section of this particular slide, which is event-driven litigation. You know, again, this is an interesting development. I touched earlier on the fact that, you know, traditionally we hadn't really seen any claims trends, but actually what we have seen again in the last 18 months or so is a new type of litigation arrive, which is what we term event-driven litigation or bad news litigation, I guess is another word for it. You know, some recent high-profile examples of these types of losses include data breaches. The Marriott case was, you know, was a highly publicized one. Air disasters, of course, you know, the unfortunate events at Boeing. You know, but also, you know, product failures and other events which traditionally may not have led to D&O litigation, but have increasingly actually been the source of claims. You know, in addition to that, we started looking at horizon risks, and we've mentioned some of them there: climate change, board diversity, the sharing economy. You know, these are all things that we anticipate will lead to greater scrutiny on boards and increasing, you know, claims activity in the future. And interestingly, you know, when we talk about horizon risks, and, you know, certainly last year when we were thinking about this, climate change was the top of the agenda, right? I don't think anybody had on their big #1 risk issue to be a global pandemic, which is what we're in now. And, you know, we touched on it a little bit earlier. You know, it is a key D&O issue. You know, how have managements responded to this? You know, how have they intervened, you know, in terms of what their government require? And what are the potential financial implications? They can be quite severe. You know, unfortunately, we have already seen corporate failures across Asia. And, you know, I've had firsthand experience with some of these. You know, they almost inevitably lead to claims, unfortunately. So look, I guess, you know, on the COVID point, which we'll go on to a little bit more detail a bit later on, there are certain industries impacted more than others, of course, which leads us on to, you know, to what we'll talk about, which is, you know, the industries and the risk profile of our clients that are seen as more favorable and less favorable. So look, I think we're now at the next poll question, which I will ask. So out of these exposures that I've just talked about, which do you think poses the biggest risk to your business and its directors? I think there's a few good topics there. I'll be really interested to see the outcome of the result when we get it in a few minutes. So just waiting still. Should be up in a couple of minutes. Oh, cybersecurity. Okay, that's interesting. Yeah, I mean, definitely you know, a risk issue that has evolved and certainly grown and reached the top of the agenda. As I said, if we were having this discussion a year ago, absolutely that would have been the top. I'm interested to see actually that COVID is fairly low. I'm not sure why that's the case. Maybe we can talk about that in the panel discussion a bit later. But no, I'm not surprised cybersecurity is up there, and the global regulatory environment, as I discussed, is a strong number 2. So moving on, Shaunna, you're going to talk about some claims trends.
Yeah, so I think it's just where we want to lead you on to next really is how these risks and sort of emerging trends translate into actual claims and losses to insurers, which is predominantly, you know, driving the market conditions that we talked about earlier. So there's a few things really. I mean, you know, the frequency of claims and the frequency of notifications is continuing at an increased level. Something we saw change maybe 12, 18 months ago. You know, the average sort of number of notifications received to our portfolio is roughly, you know, 50% higher than it was, you know, in the previous 5 years. So it's a significant number. It's a significant uptick in the number of notifications. And what's interesting as well is, you know, the types of notifications. So, you know, it does really reflect the trends that Sharon was talking about, the event-driven litigation, and COVID-19. And it's interesting to sort of look at the 2020 notifications and what's been received so far this year and how claims have emerged. And I think so far it's fair to say, you know, we've had a handful of COVID-19 notifications on the D&O side. So, you know, a couple of securities class actions, a couple of sort of investigation type claims in relation to COVID-19. Probably the biggest area we've seen that is on the healthcare side, those involved with the development of COVID-19 vaccines, that type of exposure. A very high profile, you know, very much watched by the world, I suppose. So, you know, always going to be open to that sort of risk. But interestingly, also, you know, we've probably seen more of this on the employment practices liability side. So, you know, how companies are dealing with the risks with their employees. A lot of companies, unfortunately, having to make mass redundancies, put jobs at risk, and how they've managed that process. And that really does open you up to exposures on the employment practices side. So, you know, that graph on the right-hand side there, you can see discrimination is still the #1 reason to have an employment claim. And this could tie into the, you know, the COVID issue of, you know, how are you deciding who's made redundant and whether they think there's been a fair process. And then also sort of on the labour dispute side, you know, managing the hours that people work and the health and safety, you know, it's new regulations. It's a new world for all of us, as everybody keeps calling it the new normal. And, you know, how are companies managing that and implementing that in their workforce? And it's going to be interesting to see how those trends develop over the full year, 2020 and into 2021 as well. And then if we move on to the next slide, this is less about the frequency and the type of claim, but focusing on the geography and industry split and how we see those trends emerging. So, and these are probably less changeable, and these are probably more sort of predictable and haven't changed massively, despite the increase in frequency and severity of claims. These things have remained relatively stable, particularly on the geographical side of things. So I think, you know, most people associate D&O claims and sort of the largest D&O risk with the US and the litigious culture there, shareholder litigation, and that really hasn't changed. I mean, the US always comes up every year as the #1 jurisdiction where we see D&O claims. And Europe and the UK second. So, you know, part of this is influenced by the size and breadth of the Marsh portfolio that feeds into this data. But I think, you know, it feeds back to what Sharon was saying in terms of Asia being traditionally seen as quite low risk. And you see there that actually only 4% of the notifications in this peer group came from Asia. But I suppose what's probably interesting for this audience is not just the US litigation, but also how that's changed. So, you know, this is about the origination of the claim. So not necessarily where the company's based, but where the claim was brought. And the US claims, you know, traditionally against US incorporated companies were much more prevalent, but actually we've seen a real trend over the last 12 months, or probably 2 to 3 years even, of those claims being brought against international companies that operate in the US or have a listing in the US or do business with the US even. And we're seeing those securities class actions brought against companies with an ADR listing, American depository receipts, or, you know, as I say, operating in the US. And it's sort of the long arm of the US law, which is a slightly more worrying trend, I suppose, for international companies, and something to bear in mind. And then on the right-hand side, we're breaking it down by industry sector. You know, financial institutions, financial services industry has always been, you know, a sort of risk-driven area in the D&O space. You know, there's obviously a lot of different categories within this sector, but you know, it's probably been more stable in terms of frequency, and the market as well. The insurance market never came down quite as low on the premiums on the financial institution space. It was probably more on the commercial D&O space, so sort of all of the other industry sectors there. Healthcare and media and technology are definitely the two trends that we see the most on an international basis, being troublesome for D&O insurers and troublesome on the claim side. You know, particularly large pharmaceutical companies, you know, operating on a global basis and selling high profile drugs or, expensive drugs, and, regularly hit by investigations into, let's say, price fixing, advertising, and then technology tends to be, claims tend to be, sort of changes in technology that affect their profitability perhaps, but also sort of overselling or underselling the business to investors. And so next slide shows kind of how this translates then into what we call the risk profile pyramid. So how insurers then sort of categorize those different levels of risk based on not just the industry sector, but also, the profitability of the business and the financial sort of financial strength of the company. So if you look at the green zone at the bottom, really you're thinking, we'd only expect to see small, moderate, or perhaps no premium increase at all, and plenty of capacity, plenty of insurer appetite. And this would really apply, we really see this for private companies, but those with strong financial backing and low debt levels, or public companies with a smaller market capitalization perhaps, and those that are in an industry sector that's well protected from the current pandemic situation. And then sort of moving up the sliding scale in the yellow and amber sections, pricing would be less predictable, slightly higher increases, and insurers are much more likely to be reserved with their capital deployment. And this probably applies to both well-performing companies in difficult industries, but also less well-performing companies in more stable industries. So, it's kind of one or the other would fit into this middle ground. And also having a listing in either the US or Australia with, much higher securities litigation would put you into this bracket. And as well, things like, financial exposure and claims history. And then at the very top of the pyramid, we've got this red zone. This is obviously the most difficult, challenging placements that we have. It's where we tend to see totally irrational pricing, very much a capacity shortage, a lack of insurer appetite, really difficult market conditions for companies that fit into these brackets, particularly those operating on a global basis. And this sort of covers what many insurers deem to be the sort of no-go industry exposures. And they're quite niche, specifically exposure to opioid products, cannabis, medicinal products, and also one that's I haven't put on the slide, but coal mining is another particularly challenging one on a global basis. Many insurers look to limit their exposure to those sort of environmentally unfriendly risks, I suppose. And then at the very top, an initial public offering is deemed to be extremely high risk by most insurers, particularly if that offering is made in the US capital markets. And I suppose perhaps on a more obvious basis, the risk, if the company is at risk of bankruptcy or insolvency within the next 12 months, that's a big red flag to insurers, and quite possibly would see either an insolvency exclusion or a very, very small limit of liability being offered. And so that kind of leads on to the question of how do you differentiate your risk? How do you get yourself down that risk profile pyramid and looking good in the insurer's eyes? So on this slide, we've just got a few different areas really. I won't go through all of them individually, but it gives you some ideas of what insurers are looking for when they're looking at your risk, how you differentiate your company from other companies, and what Marsh tries to do to sort of sell you to the insurers, and to sort of point out the best factors of your company. Probably the most important and has always been up there as sort of the number one factor that insurers look at is the financials of the company. So not just performance in terms of revenue and profitability, but also the strength and depth of the balance sheet. And particularly in the current COVID-19 situation, insurers are looking very closely at debt management. When are your interest payments due? Are you close to breaching a covenant? How much headroom have you got? They might want to drill down into the detail on your balance sheet, asset valuation, goodwill levels, that type of detail, which you know, maybe previously in an easier market would have been skimmed over or certainly just glanced at. And then secondly, I'll talk a little bit about the ownership structure. So insurers are very much interested in, you know, who owns the company shares? Are they listed publicly? Are you privately held? If private, you know, who are those investors? What rights do they have? What seats on the board do they have? Who holds the voting power? All those kinds of things which can influence how a company is run and, you know, and where the likely exposures might come from. And then lastly, I'll just talk a little bit about the corporate governance. So that top right-hand circle there. So, yeah, we sometimes call these the softer issues. They're probably the ones that are harder to convey on paper. And this is, you know, really it's about how the company is managed. How is the board of directors managing your exposure to cybersecurity? You know, as we saw from the poll earlier, that's very much top of the agenda. It's one of the things that keeps people up at night. So how are you managing that? How is that dealt with? And, you know, how are you going to convey to insurers that those things are being sort of well managed and looked at a very high level within the company, because ultimately it is the executive board that hold the responsibility for those things. So I guess the sort of overriding message is you want to convey the best of your company, but you also want to be transparent, and the insurers need to know, you know, the best of the company in order to make that their sort of differentiation and to put you above, or, you know, however they might rate you in comparison to peers, and to make sure you're not sort of broad brushed. So we're interested to hear on our next poll question, I suppose, how you think your D&O renewal process could be improved, you know, thinking about some of the things we've talked at today. So some ideas there: starting earlier, providing better information. Perhaps you're thinking about changing your broker or changing your insurer, or perhaps it's more about internal communication, because we know that can be a challenge for lots of our clients. We'll just wait a minute, give people a chance to respond before we check the results. Okay, well, it's great to see that you all have faith in your broker and your primary insurer. So that's nice to see. So it's interesting, actually. Like I said, you know, something we see clients having trouble with is often managing internal expectations. And I think, you know, particularly if you're in a risk management or insurance role within your company, you know, you, like us, think about risk and insurance every day. But, you know, perhaps it's not something that crosses, you know, the CFO's desk every day, is not necessarily thinking about the increase in budget spend, or, you know, the effect on coverage or limit. So that's definitely something that, you know, your broker should help with, can help with, and is important to manage. So this is our last slide now, and I'll hand over to Sharon for this one.
Sure, thanks, Shaunna. So, you know, this is really about the strategies that we develop and we put in place to support you, our clients, in terms of, you know, managing the market and achieving the best outcome at renewal. And look, some of these are fairly obvious, but I think we'll go through them all in some way or the other. So the first is communication. You know, it's really, really important that we have open communication lines with our insurers, and that our clients are seen to be as transparent as possible through the process. You know, this is about trust, and more than ever, it's really important that we start that communication process early on. We talked about differentiation, so I won't go into a lot of detail, but clearly, you know, as Shaunna has mentioned, there are several key things that we can help you do to actively, you know, manage insurers' perception of you and how you are different to your peers. The third point, I think, is really important. And one of the things I'd like to focus on, you know, primarily because it's access, you know, and look, it's a great example of us here today. You know, Shaunna sitting in London, I'm in Singapore where it's getting dark. You know, we've got the guys in India. And, you know, it may sound like a glib statement, but we do actually operate as a global team. You know, we talk to each other almost every day, probably unfortunately for Shaunna. But, you know, I think, you know, at this point in time, you know, that approach, it's really served us, you know, as professionals very well, but also our clients. You know, we're placing business now in different markets. So, you know, we will undoubtedly have programs where you'll have some capacity in India. We'll then move to Singapore, where we look at the market there. We'll go to London, potentially Bermuda. So it's really important that we're all coordinated across the globe and that we're all, you know, talking to each other about what are the risk issues, you know, what are the insurers saying? Are they consistent in what they're telling us? You know, are we getting more favorable terms in different markets? So I think that access point, really, really important, you know, and hopefully you're all experiencing that, because we certainly are working like that on a daily basis. You know, the next point around meeting, you know, this is just an additional stage of the communication point. You know, where you can, we really encourage face-to-face, or like we're doing Zoom calls, you know, particularly with your key carriers. It is really the most efficient way of providing, you know, good underwriting information, but also, you know, developing that relationship. It's absolutely more difficult for people to say no to you or to give you a difficult message. You know, if they know you, they trust you, and they, you know, they understand your business. Leverage, you know, I mean, we like to talk about this, right? We're Marsh, we're big, we have a lot of leverage in the market. You know, but it's true. And actually we have seen, you know, in this increasingly difficult market, clients, you know, luckily stay with us if they're already with us. But actually, you know, a lot of clients are moving to quality because they realize that they do need not only that global access that we talked about earlier, but the leverage a global broker provides. Negotiation, I mean, again, you know, you would expect that to be part of our job, you know, on a day-to-day basis, and it is. You know, but this is increasingly important. You know, we have to look at the structure of our programs and, you know, in a more analytical way, you know, where we're utilizing the capacity, how we're negotiating with insurers, and where they, you know, they best fit. You know, as capacity becomes a challenge, you know, we really need to, again, you know, work together collaboratively just to look at where we can deploy that capacity in the most useful way to our clients. Evaluation is important. You know, we provided some data as part of this call today. You know, please, you know, do, you know, contact us if you'd like any more data. We know how important data is to our clients. You know, it's not only there to help you make decisions about your program and what you purchase, you know, but also to really, you know, to achieve that balance of, you know, risk profile, risk transfer, pricing and coverage, which is increasingly difficult. And then, you know, finally, you know, we get to the point of selection. So, you know, I've mentioned our size and our scale, you know, but when we reach this point, you know, we're really best suited to selectively target, you know, the most appropriate lead insurers in your space. And really, you know, pushing these guys to provide the most timely and positive responses that we know is possible. So with that, I think we've covered most of, well, all of the content of our slides actually. So we'll move into, I think, the panel discussion.
That's right. Thank you, Sharon. Thank you, Shaunna. So I would like to ask you a few questions, given you bring in such an amazing perspective from a global perspective, from an Asia perspective. Nachiket is here as well from an India perspective. So let me kick off by asking you the first thing. What do you think are the top 3 risks? You've listed down that risk pyramid, many different worry items. But what do you think are the top 3 risks for the firms today, and what keeps company directors awake at night? And has COVID added to these concerns? So Shaunna, let me start with you. What are your views from a global perspective?
Thanks, Anup. Yeah, so I think, you know, looking at my client base, the portfolio that I look after, you know, I think the global regulation and the exposures that come from operating across the globe is probably the number one. You know, in terms of how to manage that many different regulations and cultures and and how to know what's going on in so many different places at the same time. I think that's definitely number one. And then sort of number two probably ties into that in terms of new regulations, and specifically I'm thinking COVID-19, and I know it came out reasonably low on the risk to businesses poll that we did, but actually I think sort of not just in terms of affecting the business, but also the regulations that people are going to need to comply with until this sort of pandemic is over, health and safety and all of those types of things, is you have to react quickly and you have to be ready to sort of continue business as usual, business continuity plans and that kind of thing. And then lastly, something that we haven't probably really touched on today, but I know whenever I talk to my clients is something that always comes up, and possibly, it's possibly not something we talk about that often because it's to some extent uninsurable, is reputational damage. What to do if your company has, a sort of a reputational issue or receives bad press, bad coverage, and that's not necessarily, there are certain aspects of it that would be picked up under a D&O policy if that translates into a claim of some kind. But I think that definitely keeps some directors up at night, is how to fix that and how to keep your brand and your company strong.
Thank you. And Sharon, what are your thoughts from interacting with clients in Asia?
Yeah, look, I mean, I would echo, a lot of what Shaunna has just commented on. I don't think there are any particular differences, although maybe a couple of points that, that I will just focus on specifically. Absolutely, it's that increasing awareness of our clients in Asia that they're not Asian, they're global, and they really do have to consider the fact that their global operations are most likely the operations and the incidents that are going to lead to D&O claims. I mean, we've seen a couple of, very high profile, highly publicized, cases in Asia of just this. I mean, the Nissan case, which has, been all over the news for the last, year or so, prior to that in Japan, D&O claims were almost non-existent, and a lot of Japanese companies have now woken up to the fact that actually they do really need to look at their D&O programs, and their directors need to follow very, very strict corporate governance, where previously that they hadn't. I guess secondly, moving on from that global kind of multinational piece, again, we touched on it earlier, employment related issues I think are increasingly common. And actually, what we've seen in the soft market, are a lot of our D&O policies extended automatically to include entity-related, employment-related claims. So, all of our clients have thought for a very long time that this is just a coverage that they have. Now we're seeing that disappear. So employment-related issues are also something that comes up frequently. And then, finally, we've mentioned it a lot of times, and it was top of the poll earlier, cyber risk. And look, cyber risk is a very nebulous term, and we're not just talking about cyber insurance, we're talking about all of the cyber risks that are constantly evolving that organizations have. So I think that would be my top three from an Asian perspective.
Thank you, Sharon. And Nachiket, let me just ask you from an India perspective. We hear Sanjay mentioned, many independent directors get very uncomfortable with the increased regulatory scrutiny, new laws, and possibility of criminal action also. So what's your view from an India point of view?
Absolutely. I completely concur with what Sanjay is saying. Gone are those days when India used to be insulated. Some of the new age laws, the new Companies Act and the new bankruptcy law are clearly empowering the investors and the overall community to kind of press for their rights. When you look at the new Companies Act, things like whistleblower mechanisms are compulsory for a listed entity. Directors and specifically independent directors are held accountable now, and there is an explicit mention in the law for that. If there is a fraud, which is a major worry in Indian context, the liability by law is unlimited. Not only that, we have for the first time in the law provision for US style class action lawsuits. It can be against the entity, directors and officers, or even the auditors. A lot of times we have seen after the bankruptcy law, which has been passed in last 3 years, a lot of times we have seen that the auditors have been questioned as to what were they doing as one of the important gatekeepers when things go wrong, when the accounts are inflated, etc. So the law empowers you to go after auditors as well. One of the other thing is conflict of interest is a big issue in India, and a promoter fraud. What happens in the process is the directors and the senior officials get caught into it. The promoter runs away, and these guys are left high and dry to fend for themselves. One of the top banks in India had an issue where there was an allegation of conflict of interest against the CEO. They fired the CEO, but what followed is the class action lawsuits from the US investors. Similarly, the top NBFC in the country, very well reputed board, um, it was in a way too big to fail kind of a company where government had to intervene and supersede the board. You know why? Because the senior officials were involved in fraudulent lending practices. They had preferential treatments as to who they want to fund. You will be amazed, Anup. The authorities by now have attached close to 600 crores worth of individuals' properties. Third is when we look at some of the issues in terms of high profile boardroom fights, alleging corporate governance failures, alleging issues in terms of related party transactions, issues in terms of operation and mismanagement of the company's affairs. Um, we have seen this with Salt to Software conglomerate. We have seen this with Aviation Company, the biggest IT company as well. Um, no longer we can think that the environment is benign, because one of these case has seen the legal cost expenses going beyond $20 million. So a lot is happening in India. From a COVID perspective, um, it's in a way, when I look at the global financial crisis, it's similar thing, that there are widespread liquidity crunch related issues. Obviously the macro sentiments are depressing. What we saw then was followed by Satyam, and then followed by FCCB crisis. In today's time, we are looking at issues in terms of after the lockdown, we saw that one of the South Korean backed company in India started their operations, and it resulted in a pretty large casualty where a lot of people got injured, and several people died. So the NGT, which is the regulator, which quickly swung into action, and then he put a levy of 50 crores worth of fines on directors and officers. As many as 13 to 14 directors and officers have been arrested, and then they are getting prosecuted as well. So regulatory investigation is another big area. We don't necessarily see shareholder actions in India, but regulatory actions is very big. Similarly, I'll just give one more example. The largest stock exchange in the country had an investigation from SEBI, wherein they were allegedly giving preferential treatment to the select brokers for high-speed trading. They have been recently levied a fine of 1,000 crore plus the amount, and the individuals, the ex-MDs, have been asked to disgorge some portion of their salaries for 5 to 6 years. So clearly, a lot is happening, and I can relate to what's happening in London or in Asia or around the world.
Interesting. So apart from this changing risk environment, corporate governance standards, Shaunna mentioned that, are also attracting a lot of scrutiny, and especially after a spate of some high-profile frauds, whether they are in globally or in India, and a lot of increased regulatory oversight as well. So Shaunna, what's your experience with our global clients about these governance standards, and what firms are doing around that?
Yeah, it's a really difficult topic. It's a difficult issue to manage internally, and it's a difficult one to convey how you're managing it to insurers as well. We find that what insurers are worried about a lot of the time is a company might have practices and processes in place to mitigate these risks and to follow, and to keep the right side of legislation and regulation. And but you're always open to human error or, you know, the decisions of individuals. And that's, you know, that's what the insurance is there to protect against. You know, I had a recent example. One of my clients is a large global mining company, and they have sort of specific practices. They have a specific sort of escalation process in place when they're concerned about a particular issue. And what happened was, you know, somebody logged an issue with a particular area that they were mining, but it didn't get passed up the chain in the usual escalation process. For some reason, it got, you know, it got missed, or the person didn't log it properly, or something like that. And it led to them doing something which they shouldn't have done, and they were, you know, unable to rectify. So, you know, I don't want to go into too much detail because it might sort of give away the anonymity of our client, but it essentially, you know, it just kind of demonstrated to me that, you know, this sort of really big global company that has these processes in place can still fall foul of regulation, and that, you know, led to a notification to their D&O program. It led to a government investigation into the company, into how this process happened and how it went wrong. And actually, it also led to the CEO resigning over the issue because you know, they felt compelled to show accountability for what went wrong.
And thank you, Shaunna, on that. Sharon, is this true for Asia as well, where governance standards have been arguably less stringent?
Yeah, I mean, absolutely, Anup. I mean, you know, I think it's true that in Asia, you know, particularly in certain countries, you know, where culture, I suppose, and local practices have been relied upon more so than formal. And certainly, you know, global standard corporate governance, we're absolutely seeing, you know, clients more attuned, you know, to the fact that they do need, you know, to be at that global standard, you know, particularly, you know, if they're listed in a foreign, you know, jurisdiction, as we've spoken about, or have exposure, you know, to foreign operations. So yeah, probably not a lot more to say than yes, absolutely.
Thank you. And Nachiket, how about India? So Indian investors have been notorious for being very accommodative to all sorts of governance failures. Is that true in India as well today?
To an extent, true, Anup. It's surprising how they can accommodate, and the other parts of the world, the investors take directors and officers to the task. So to an extent, the trend is changing. It's not that they don't raise their voice or opinion. If you see the trend, the investor participations, especially when there are proxy advisory firms who are involved, they are educating the investors to exercise their rights and during the voting process. So if you see the trend, earlier, a lot of such investors would remain abstain from the resolution proceedings. Now, increasingly, 50-60% attendance is there. And then they come together ahead of time, they decide a strategy and vote on particular issue accordingly. There have been examples and then storied examples. I mean, the largest automaker in the country it's a cash-rich company, wanted to set up a new plant in Gujarat, but they asked their parent to pump in money. So the domestic institutional investors had raised a concern as to why should we not invest? Because if we are relying on parents' money, eventually the profit and the royalty money will go out of India. Similarly, there have been cases of the directors and officers allegedly getting paid excessive remuneration. Shareholders have blocked that. There have been cases where one of the large cement manufacturer wanted to increase the royalty payments to their parent. The minority shareholders actually ended up blocking this. Some of these things are already part of the new Companies Act now, so it may not see a repeat, but there have been such instances where the shareholders have exercised their rights.
Thank you. And with increased participation from domestic financial institutions, also with mutual funds investing and all, I think this whole trend is probably going to go up and all. Let me ask you my last set of question to three of you is more about brass tacks, more about nuts and bolts. So this all means that there should be, increased D&O claims activity. This also means that, people may be looking to buy more limits. So Sharon, you mentioned that you used to place in London, $500 million in sterling worth of limits. So if I were to ask you, market is tough, rates are hardening. Are clients looking to buy more limits? And if yes, is this capacity available?
It's an interesting question because
and it's both to you and to Shaunna as well.
Sure. Should I start on that? Go ahead, Shaunna. Why don't you go ahead?
Okay, yeah, I mean, I think we possibly have different answers in terms of the capacity changes. As we talked about earlier, I think the market's probably, it's sort of further down the line, in the hardening process in London. So, I mean, it's actually the opposite. So, you would think that with the claims activity and the risk exposures out there, that clients would be looking to buy more limit. But actually, I would say that we saw increase of limits year on year in the soft market because capacity was cheap. It was often you could get another 10 or 20 million pounds of coverage for no increase in premium because of the savings you've made on the rest of the program. Now we find that actually a lot of clients are reducing their limit purchased, and that's because, for sort of one of two reasons. Some clients are making a conscious decision to reduce their overall limit because, because of the cost mainly. Particularly smaller companies that perhaps bought more limit than they needed, as I say, because it was good value, it was economically viable. But actually now the cost is exponentially increasing. They're kind of reevaluating, do they really need that much cover? And if not, then, let's buy less and put those premium savings somewhere else. And then, the other sort of side of the coin is those that can't get the capacity that they used to buy. So, as Sharon mentioned, I've got one particular client who previously bought $500 million US dollars. Last year, that came down to about 440 million. And the likelihood is this year it could be as low as 250 or 300 million. And that's, partly some insurers walking away from the D&O market or walking away from certain types of industries. And then it's also, every single insurer on the program previously might have put out $20 million on one risk, and now that could be as low as 5 million. So that capacity shrinkage has definitely meant that some insureds are being forced to buy less, and others are choosing to buy less because of the cost.
And so let me ask this to Sharon. Sharon, do you see this happening in Asia as well? Do you see clients having their limits and programs reviewed by board or by independent directors? Or it's still a purchase function, it's still a risk management function in Asia?
Yeah, I mean, it's a really good question and interesting, actually earlier on our last poll question that we asked the audience, what they would change most about their D&O process was, that issue around internal stakeholder management. I think in the good times, it was very easy just for the risk manager to go to their board and say, hey, the premium's going down, the limit's going up, and everyone agrees, and it's a simple discussion. Now, absolutely, these discussions are increasingly reaching board level. And I have a particularly difficult case at the moment where the clients asked us to extend for a month, in a difficult market where they're probably going to have to pay more premium just because they and probably us could have done a much better job at managing, those internal shareholder discussions, internal stakeholder discussions. We thought we alerted them early on to the market conditions, and we thought that we had done everything right in terms of, messaging along the way. But unfortunately, that particular client had just never had that experience of delivering bad news internally. So this process of buying is now reaching the CEO of quite a significant bank. And we're actually going to present to them in a couple of weeks about exactly what's happening in the market. So I think a big lesson to be learned there for everybody on this call is, that internal stakeholder management is really key. And if we're doing our job right, and we should be, you need to be listening to us throughout the process and delivering these messages, as and when they arise. Because, I suspect that, when we are having to make decisions about reducing limits, increased price, or even restriction of coverage, that decision is going to reach that next level in the organization, and it could go all the way to your CEO.
Fair point. Thank you. And Nachiket, my question to you is, Indian insurers also offer a lot of additional capacity, probably like Japan and elsewhere. And have you seen them being particularly cautious about certain industry segments, especially in light of COVID?
Sure. So COVID has really tested everyone, both our clients and insurers. So I won't say in general that all renewals are difficult or all clients are not getting what they desire for. But in pockets, yes, definitely the insurers are very, very cautious. So a couple of things, insurers are increasingly looking at sustainability of the business, especially if you don't have a dependency on a particular revenue stream. In terms of your debt position, will you be able to service your debt position? And then lastly, how are you managing your disclosures, especially when you are a listed company? So keeping all of these things in mind, there are few industries like retail, hospitality, aviation. They have really suffered heavily during COVID times. So obviously the insurers are looking for more responses from client in terms of understanding the operational part of it. Second is there are US listed clients. For them, not only we have seen claims, the appetite from the underwriters side has drastically gone down. So there is quite a bit of correction both in terms of pricing, limits, and coverage as well. Um, and in a few cases, even the deductibles have jumped up substantially. Third bucket, I would say, is the people who are linked to the capital markets or to an extent mutual fund and the GPL clients. Clearly, the private equity VC business where you're not sure if you're nearing the end of the fund duration for next 12 to 18 months, what kind of valuations or exit or alternate investors you will be able to get on board. Mutual funds, we saw one of the classic case, the one of the top mutual funds in the country had to voluntarily do away with some of their schemes. It is first time ever it has happened in India. Usually it is the regulator who will force you to shut down, but the mutual fund itself announced that they are doing away with 6 schemes, essentially due to redemption pressures which they could not cope up with. So there are cases where it's becoming very, very difficult to garner the desired outcome for the clients. However, there is an upside or there is a silver lining. Relatively speaking, IT companies, pharma companies, or maybe banks to an extent are doing well. So to that extent, yes, if your risk is well managed, your management is able to navigate tough times, the underwriters are willing to kind of give you that extra lease of life as well.
Okay, great. So I think if I were to ask you last question, and let me ask you, Shaunna, this first. If there is one piece of advice you can leave our clients with, what would that be?
It's a tricky one. I think in terms of the D&O placement process, I think the number one piece of advice, it goes back to the poll we had earlier in terms of managing internal expectations. Communicate to your internal stakeholders and be flexible. Have a plan A, but have a plan B and a plan C.
Super. Sharon, one piece of advice before we open the lines for questions.
That was going to be my response, so I'll give you my second tip, which is I think just building in as much time as possible into the process is helpful, and listening to your broker. You have a great team in
Some
India.
bit of self-promotion, huh?
So follow the advice that you're receiving.
Yes.
So I'll leave it at that.
Nachiket, last piece of advice.
Maybe an operational item, but I think the D&O claims hit you harder when you are financially impaired or not doing well. I think if you can negotiate, that is one thing you should keep it out of your policy exclusion list, the bankruptcy exclusion.
Yeah, good point. Huh? Good point. Fantastic. So you've been a very, very amazing panel, and we've had a very amazing audience as well. Unfortunately, we are all digitally connected, don't have a face-to-face connect, but the lines are open. You have a chat function. You can send your questions over on the chat box, and our panel would be very happy to answer these questions. If you have a question, you can raise your hand as well, and we can open your line.
And while we wait, do you want to we could just quickly, I mean, we've got two questions on the chat function, on the Q&A function, which probably overlap with each other in terms of the sort of information required to for either a D&O renewal or a first time D&O claim.
Sure. Shaunna, would you like to take a stab at it in the world's most difficult market?
Yeah, so I think the answer is that it really varies massively from company to company, depending on the size of your company. So, if you're a small private entity and you're looking for, a small limit of D&O insurance, then typically, we're looking for a proposal form, and that might be fairly long for the first time purchase, and then a shorter version at renewal. But if you're a large global corporation or a smaller company, but perhaps you have a lot going on at M&A activity or refinancing, something like that, then the best way to make sure you're giving underwriters everything that they need for the renewal is to do a call or a presentation of some kind, and give them the opportunity to ask questions live to you, to try and avoid a sort of back and forth over email. That's what we find works best to get insurers comfortable with the risk.
Good, fantastic. Any other question which our audience would like to ask? Since there are no further questions, I think it's a wrap for the day. So thank you so much to our audience for joining us today, as well as Shaunna, Sharon, and Nachiket for joining us today. Really appreciate it.
Thanks, everyone. Goodbye.
Thank you all.
Bye.
Thanks for inviting us, and thanks to the audience for listening in.